Okay, because we're talking about the Cold War, it's very important that we address where the government fits in the economy and economics. So we're going to talk about government policies and how that impacts economics, and then we're also going to talk about a couple of other structures of economics that are important to know about. So, government policy, the impact of price controls and taxes. Price controls, that's exactly what it sounds like. It's another way of influencing policy. It's just one way of doing that. It's where government tries to either prop up prices or repress prices. That's a very, very basic way of describing price controls. And if you scroll through and have a chance to read, again, this same theme with econ, there's a lot more about price controls in here that's really quite interesting. Talks about rent control and the impact that rent control has. And it also talks about things like farm subsidies and the actual impact that that has. But keeping moving quickly, we're going to talk about the second kind of price control or the second kind of policy control that government uses, and that's taxes. It's important for you to know, no matter what level of government we're talking about, all of them use taxes of one sort or another, and this helps raise money to pay for public expenditures or public benefits. So it might be in the form of sales tax at the store. It might be in the form of income tax once a year that we pay and that comes out of our paychecks. It might be in the form of property taxes when you buy a home or a farm. Those are different kinds of taxes. They also have an interesting concept down here about the fees that we pay on cell phones and things like that. So again, if this is interesting to you, take some time and read more about it. There's a lot of really fascinating things in here. Jumping off of government policies, we're going to talk a little bit about international trade. And the fact that when nations trade with one another, just like when individuals trade with one another, they are better off on the whole. So this is a fundamental insight of economics, a fundamental tenet of economics. Exchange makes people better off on the whole. We're going to see later that individually that's not always the case, but on the whole, economic exchange makes people better off. And the way it does this is through specialization. I don't need to waste my time doing activities that I'm less good at when I can complete activities that I'm much better at or more efficient at, and then trade that excess with someone else who's really good at something else. Comparative advantage and the gains from trade. This gives some summary of all of that stuff that I just scrolled through. They give this hypothetical market of a person named Crusoe and a person named Robinson. And Crusoe, in this example, is better at creating literally everything in their market. And so they try to figure out how it can be that Crusoe, who's better at everything than Robinson, is actually better off by trading with Robinson. And they talk about comparative advantage. Even though, for example, Robinson produces fewer coconuts per hour than Crusoe, he has a comparative advantage in producing those coconuts. It's not the absolute productivity, but rather their respective comparative advantage. So this is important in this and helps clear it up a little bit. By changing their allocation of time between fishing and gathering coconuts, Robinson and Crusoe, in effect, transform fish into coconuts. Robinson faces a cost of 1/3 fish per coconut. Crusoe takes 1 fish to produce 1 coconut. When Robinson specializes in producing coconuts only, and Crusoe specializes in producing fish only, their collective economy increases its total production. That's where comparative advantage comes in. And then they share that increased total production. So this is kind of a summary sentence of this. As long as trading partners differ in their comparative advantage, they can improve their overall well-being by specializing. So as long as Crusoe is better than Robinson at fishing, and Robinson is better at producing coconuts than Crusoe is, they can combine their efforts and both of them improve their overall well-being. So now we start to take this to a more international scale. If trade increases a nation's well-being, then why is there so much public opposition to international agreements designed to promote freer trade? The one that comes up a lot with this is NAFTA. CAFTA is another one. These are agreements that countries come to with one another for opening up trade. Free trade agreements is what the FTA stands for. A lot of individuals oppose, in general, free trade agreements. So it's important to think about it this way. When countries become increasingly specialized, so think back to Robinson and Crusoe, if they have differing comparative advantages, when countries become increasingly specialized, the costs and benefits of trade fall on different groups of people. So on the whole, the country's economy improves, but individuals often suffer. Okay, so if you happen to be one of those people who is really good at the activity that's being eliminated in favor of specialization, then you do not like this particular free trade agreement. Okay, we're going to drop down a ways. We're going to talk about firms because this is a topic, or this is a term that comes up a lot. A firm is someone who's responsible for supplying goods and services in the company or in the economy. Firms are often like a company or a government entity. Remember, if you think about the law of supply, as long as the price of the goods rise, firms or companies, they are willing to supply more. Here's an important concept. We assume a firm's goal is to maximize profits. They want to make money. Profits are defined as the difference between total revenue and total costs. This is kind of a weird concept, a little difficult to understand, but what we call economic costs, that's a defined term, and it includes the opportunity cost of all the resources required to make production. Accounting costs are only black and white dollars spent. Accounting costs don't include opportunity cost, which we know from our lesson face-to-face. Opportunity cost matters, but accounting cost doesn't include opportunity cost. Okay, the last thing I want to talk about is a few types of competitions that are, a few type of market competitions that are called imperfect. So when we have perfectly competitive markets, they match buyers and sellers and they find equilibrium. When we have imperfect competition, we start to see problems in the economy. For one example, if a market only has one or very few suppliers, it's called imperfectly competitive. Remember, the gas market, where there were so many suppliers, that was a highly competitive, not quite perfectly, but highly competitive market. So here's our first example of an imperfect competitive market. It's called a monopoly. A monopoly happens when there is only a single supplier of a good or service. Mono means one. Monopoly means there's only one supplier. The reasons for this is because there are high barriers to entry. That means it's hard to get into this industry, hard to get into this service or good. And here's some barriers that often cause a monopoly. Ownership of a key resource. The biggest example, a most common example of a monopoly is electric power companies. If you look outside, you see distribution lines, electric lines on the streets, on the roads, running through our valleys in larger areas. There's only one set of those anywhere. It'd be ridiculous to have multiple sets of power lines in our nation. So one company owns each community's distribution lines. That's why electric power and the distribution of electric power is a monopoly. Another example of a barrier to entry is government-created monopolies. There are situations where we protect certain people who are innovators. Patents, copyrights, we give them exclusive rights to produce things that are their idea. This is a foundation of American society. If you create something, you have the right to have the ownership of it, but that creates a monopoly. And then the other barrier is when you have a natural monopoly. I'll highlight this. This is what happens when there are large fixed costs that cause the firm's average costs to be falling at a scale of production that can serve the entire market. Examples of a natural monopoly are railroads, pipelines, and cable TV. The problem with monopolies has a lot to do with prices. And here's the rub. This is the important concept. There is no competition to drive profits towards zero, no competition to make things better for everyone.